Hey, Mike from Mike Buys Houses here. I was talking to a homeowner the other day who is looking to offload some of his rental portfolio. There's been a lot of changes to, or potential changes to the 1031 exchange and future talk about changes to capital gains, everything like that. So he was looking to get rid of his property and he was talking to me about different ways that he can lower his capital gains impact when selling his property. So this guy had owned his property for a long time. He's had tenants who had paid down his equity, and at this point he's looking to cash out and sell his properties, and he was kind of wondering what are his options to decrease his tax hit as far as capital gains when he does sell his property. And these are kind of the things that we talked about. So on the sale of his rental property, the homeowner knew that this was going to trigger a tax consequence known as a capital gains tax. And with that, we talked about what that is first, which is basically just a tax on an investment that has been owned for longer than 12 months, which is different than a short-term capital gains tax, which is usually at a higher interest rate. So with the long-term capital gains, while you still face the taxes, you are rewarded for your patience with a lower tax rate than the short-term capital gains tax rate. The capital gains taxable amount is determined by taking the sales price and subtracting out the original purchase price. So new sales price minus purchase price is your capital gains taxable amount. For most people, the long-term capital gains tax rate is going to be 15%. So that number applies to anyone who makes between $81,000 and $440,000, give or take, depending on the time that you watch this and the most current changes to the tax code. And for joint married couple filing, it's usually around $495,000, $500,000, and that's going to get you in the 15% tax rate on long-term capital gains. So any sale on an investment that's been held for longer than 12 months is going to be taxed at 15% via this tax bracket. There may be some changes depending on when you watch this and your income levels, so it's safe to assume 15%, but check with your CPA obviously before you make any decisions using any numbers you get from YouTube. So check with your CPA before the sale, but 15% is the usual long-term capital gains rate for most people. So when selling a rental property that you've held for longer than a year and you're looking at facing long-term capital gains, there are really three options to help you decrease that amount or avoid these taxes altogether, depending on what your long-term strategy is. So there are really three options, and here they are. The first option, if you want to avoid long-term capital gains rate, is to turn your rental property into a primary residence. Depending on your situation, this could be a good option for you. You could move into the property, fix it up while you live there, and then make sure that it's at top dollar condition and sell the property on market for top dollar. And the requirements for this is you have to live in the property for 2 of the last 5 years. They don't have to be in consecutive years, and you can use this to sell your property as a primary residence and significantly reduce your tax load. So this is a great way to decrease or even avoid long-term capital gains rates by selling your rental property as a primary residence, by moving into it and no longer running it as a rental. So your first option is to move into the rental as your primary residence and then decrease your tax rate because of that. If you do decide to move into your rental property and use it as a primary residence in order to decrease your tax hit, then I would definitely recommend consulting your CPA before you make that decision. Any time that you had taken any depreciation into your house may change what your tax hit's going to be, even if you turn it into a primary residence. So consult your CPA for your specific needs, but you can go into that meeting knowing that if you turn this into a primary residence, then you have the potential to significantly reduce the tax hit that you're going to face. The second option to significantly reduce the taxes on your property when you sell a rental property that you've owned long term is to do a 1031 exchange, at least at the time in this video. This has been in the works and possibly the discussion of getting rid of that or making changes to that. But for now, what that does is it allows investors to purchase like real estate with the profits in order to defer the tax consequence. So a lot of real estate investors will use this as a long-term strategy to continue to level up almost with the sale of a property. They'll then take the proceeds and invest that in another investment producing real estate property, and they will then defer the taxes and then sell that property in the future again, and you can 1031 again into another bigger property. So that's some of the strategies that some real estate investors use to defer their capital gains for long-term holds that they've had. But there are some requirements to doing a 1031. So here's some of them that we talked about. First, if you're doing a 1031, the most important thing is to know that you don't have a lot of time. So you're going to need to identify a potential like property within 45 days of the sale. That's the first thing you're going to. And the second thing to know when doing the 1031 exchange is that you have 180 days in order to close on that second like property. That means that you're going to be buying another property that's income producing, so not a personal residence. And that's what they mean by like property. But check with your CPA for the exact definition to make sure that the property that you are planning on purchasing works for the 1031 exchange. But basically you have 45 days to identify that property and then 180 days to close on that property. Otherwise, the initial long-term capital gains from the initial sale will be called due at that time. So 45 days to identify, 180 days to close. Those are pretty key things to know if you plan on doing the 1031 exchange. And the third option, if you're looking to decrease your long-term capital gains hit, is to sell on terms. This is what we talked about here. Landlords who are looking to offload their property can sell their property on terms and maintain their cash flow and decrease their liabilities. They don't have to worry about repairs, nothing like that. They act as the bank. I've never called the bank to let them know that the work that I'm doing here needs any changes. I don't think they would care, and that's the role that landlords can take when they work with us. So when selling your property on terms, you're able to maintain cash flow, get rid of the headache of tenants, don't have to deal with any more issues like that. Just collect the monthly payments, make interest on your money, and be protected by the property that you've owned for years. It's a great way to lower your tax hit as well, because you only get taxed on the money that you collect that year. And since you're spreading your money out over time, you're able to collect more money and you're able to pay less in taxes each year. So it's a nice advantage that retiring landlords, or even landlords who no longer want to be landlords for that specific property or for their whole portfolio, can exercise. So if that's something that interests you, you can reach out to me at 267-984-4765 or visit us at MikeBuysHousesPA.com and fill out the forms. And we would love to walk you through what some of the options would look like for you to sell your income producing property on terms to us. So again, if that's something you want to explore, give me a call at 267-984-4765. We look forward to helping you.